All right. Welcome back to the Canadian Macro Investor Podcast. Daniel Foch here, one of two hosts of the Canadian Real Estate Investor Podcast, and Simon Belanger, one of two hosts of the Canadian Investor Podcast. And we get together every Friday, go live on a bunch of platforms: Instagram, TikTok, YouTube, Facebook, LinkedIn, X, and just talk about macro, what's happening in the market, how it's going to impact the asset classes that each of us discuss on our shows. So what are we talking about today? There's a lot of stuff going on.
A lot of stuff. So we heard about the Bank of Canada rate decision, their monetary policy update, which we'll be touching quite a bit on. Aside from that, I did a little bit of research, and I'll make the case as to why I don't think the U.S. can raise rates. I'll also compare the CME Fed Watch data to prediction markets, completely different. It's like they're living in two different worlds. So we'll touch on that too. I think we'll probably talk a little bit about AI. I think last week you mentioned in passing the new models that have been released, some recent ones. There were some a Chinese model that was announced as well. I think Moonshot, if I remember correctly.
Yeah, Kimmy,
Kimmy. How that could impact U.S. models, markets as a whole, the profitability behind it. Also saw the announcement. I don't know if you saw that Tourmaline is looking to build a new data center in Alberta and using a natural gas-fired power plant to power it. So just building on what was announced by Meta.
One?
No, that's a different one. It just got out this morning, CBC article, so we can touch on that as well. Yeah. Mm-hmm. So anything else? I know like housing, there's some fun stuff going on there too. Bank of Canada potentially.
Bank of Canada. Yeah, I mean, Bank of Canada, no hike. And then also I think, the monetary policy report, it obviously was, they observed a lot of interesting stuff. The funny part is like a lot of their models mentioned that they had to have oil from 70 to 75 a barrel. And then it skyrocketed the next day. And then, they also called out condos, a couple of other things like, they downgraded their forecast for housing on the on GDP next year. So lots of stuff on the go that I think we'll get into when we get into the monetary policy report side of things.
Okay. Yeah, let's start there. Do you want to start by the just essentially the announcement, interest rate announcement, what the Bank of Canada said? Did you have a chance to look at the press conference?
Yeah. So, I mean, I think you and I both said that we expected this outcome, right?
Yeah, exactly.
Like I'm not surprised, and you can tell the market doesn't care anymore. Like market's not surprised. There's two reasons why I think this might be the case. Because like even when I think about the mortgage products that people are using, and I've pulled up this chart before, but I'll pull it up again. The CMHC mortgage, mortgage industry report.
Yeah.
It shows that basically, the majority of, in the most recent reading, the majority of borrowers, new mortgages that are being issued are actually variable. And then the second most common is your 3-year fixed. So you would think that your borrowers or your market is actually, should care about the Bank of Canada is doing, but I would say that the bond market is really a lot more in control of what's happening. I think in the rate environment now, housing side, like 5-year fixed mortgage versus the variable, you can set that aside. But I just think that the bond market is really doing more work on rates and on setting expectations of the Canadian economy than what the Bank of Canada does. So I think that they've kind of just become a little bit less relevant to the consumer. That people like, the joke that I made was like realtors are no longer rushing to post about the Bank of Canada announcement on their Instagram pages. But that I think that like is kind of an embedded sign of, how consumers are reacting and thinking about their role and what's going to happen with rates and whether or not we even care. Are people just bored, right? Are they exhausted by thinking about it? I don't know what your thoughts are there.
Well, I mean, I think I think people are just tired of hearing it. I mean, a lot of realtors on TikTok or whatever have been saying for better part of 3-4 years that there'd be, sideline buyers coming in, rushing in, buying homes as interest rates would come down. It was the first one, oh, just wait, it's going to happen. Never really materialized. And we're what, like 300 basis points lower at this point, 275. I don't know the exact amount from the peak. And it's also messaging, and you're kind of the exception to the rule. That's why I love the Canadian Real Estate Investor podcast, but I like what you talk about because you're real and you don't try to sugarcoat it just to pump your bag, but increase your business. But the reality is, a lot of the real estate industry, and of course, I'm just talking as a whole. There are some really good and realistic realtors and mortgage brokers out there, but I think at the end of the day, they've been sending this messages that there was pent up demand, and it was just going to happen, never happening. And now, the data better than I do, but I've seen it time and time again. We're looking at pretty rough market, especially in the areas that had the most run up during the pandemic.
For sure. Yeah. Well, it's interesting because the markets, let's just call it Ontario and BC rather than going even city level. But Ontario and BC, let's go back all the way to like peak of the market, right before the Bank of Canada fired the rate hiking cycle, warning shot. You have Ontario and BC are down, 9 to, I'll pull up a really cool chart on it, but they're down 9 to 20% from that period of time. Every other market is up in Canada, like at a provincial or local level, or not a local level, but if you go like province by province,
before rate hikes, right?
Yeah. So they're up since before rate hikes. So the change in house prices from January 2022 to present day in Nova Scotia or Quebec or whatever is some of them are hitting all-time highs, man. So it's really becoming a tale of two markets in Canadian real estate, which I'll pull up a chart to kind of show you, like visualize what I just mentioned actually. But yeah, no. So unpacking that, well, why would those markets be doing better than Toronto and Vancouver? Well, they're price to income. People didn't have to lever up as hard to buy, and so you get the result that there's greater affordability, which means market participants can still purchase today because they're not seeing a negative wealth effect. You're not seeing all this volatility and fear, and so I think that's how we kind of got where we are today.
Well, it's all about the one image I tend to just remind myself of, it's the markets are like a pendulum, right? So if it swings too far on the right side, it's going to swing back on the left side. If it stays near the middle or doesn't move too much, then it won't move too much one way or the other. So I think I know it's an easy visual, but I always like to think about that. Yeah. And you can just think about that visual, and it explains a whole lot when you think about the most expensive markets and the ones that are doing well right now.
Yeah. Yeah. So if you look at the chart here, like I basically have every province: Alberta, BC, Manitoba. So if you like New Brunswick's like just coming off all-time highs. Manitoba looks like it's hitting all-time highs. BC is down, right? And I have the table below that'll actually show you the delta from January 2022 to then. But like Newfoundland, Labrador, all-time highs. Nova Scotia, Ontario's down. PEI, they're up, not meaningfully, but up. Quebec, all-time highs. If you look at like Newfoundland and Labrador since January of 2022, so a month before the rate hiking cycle started, up 40%, where Ontario's down 20. So
it'd be interesting to see even more like localized, right? Because I live in Ottawa, and people that know me know that, and
I can go local for you. Give me a second.
You can go. Yeah, I'm just kind of curious, right? Because it feels like a bit different in Ottawa, although I still feel like, just looking at prices, and this is just anecdotal, I still feel like it's probably down a little bit, but not probably as much. Yeah.
If you baseline from your January 2022 average price, which was 704, it is up about 6%, but it's been pretty volatile.
Yeah. But Toronto skews so much for Ontario, right? Like it just pulls everything down or up. Yeah,
for sure. Yeah. Yeah. So I mean, like on a city by city basis, it's also pretty volatile. Like you get less data, right? So yeah.
And just to get back to the Bank of Canada announcement, so you said you saw the press conference. I know they talked about the monetary report, but they also had a question regarding condo corrections, especially in the GTA and Vancouver. And there was a reporter asking that and what they thought about this potential buyout program. I can't remember the wording they use, and obviously, I think it was the deputy governor that answered the question, Carolyn Rogers, and she was saying, "Look, those markets are undergoing a significant correction." Like that, these are the words that she used. They don't really know too much about the bio program. It's clear that she was tiptoeing around and didn't want to get into
Mhm.
the political crossfires there. But she said maybe it could alleviate that a little bit. But she did acknowledge that those markets are facing some significant corrections right now.
Yeah, and they even mentioned that in the monetary policy report a couple of times. So I've always tracked like how many times the Bank of I want to know how much they're paying attention to the housing market, but I literally have a historic chart on number of times the word housing appears in a monetary policy report, and this one's pretty high by comparison. I think like 11 mentions, whereas like a low one would be like 4. Um, and you can see here under the residential investment reading, basically, they expect it to increase, but there's some affordability challenges in some housing markets and a large stock of unsold small condominiums in Toronto and Vancouver. And they do mention condos again, about when they're in their risk segment, where they're talking about the pickup in GDP growth may not be sustained. And one of the reasons is because the overhang of unsold condos in Toronto and Vancouver, along with affordability issues, could mean that a recovery in housing activity is slower than expected. So
Mm,
I mean, you would really only put those in if you're not super confident that your model is going to be correct, and you want to build a bit of a buffer to, if people call you out on being wrong later, you can kind of say, well, we did mention that here. Look at this note, So I think that, they're paying a lot of attention, more attention than I would have expected, to the risk that is happening in these asset classes right now, and especially the condo side of things.
yeah, and even this one here, so it kind of shows exactly what you were talking about here. So you see the GDP forecast,
Yeah.
GDP growth. So you see the yellow is the housing. So you see it was a negative drag in Q1. For Q2, they're seeing it as essentially being, flat.
Yeah.
Not much of a positive, I guess, a slight positive. But yeah, that's what they were saying. It went from a drag to being like no impact. But clearly in the forecast, they are factoring in that it could continue to be a negative impact there.
Yeah, and if you annualize that out, they actually put in here that housing would go from, so their original forecast for 2026 was that it would be negative 0.1 percentage points on the GDP growth. So it would be a net drag. And now they're estimating that it'll actually be a negative zero point 0.2 drag. So they've doubled how much they think it's going to drag on GDP. And then they go to next year where they're expecting just a slight improvement at 0.1% positive, not till 2028, where you really get it pushing those numbers that we saw, kind of normal pre-pandemic GDP growth from housing market activity. So I think that this tells me that they are not feeling super optimistic about the housing market right now, when I think about, the Bank of Canada's language around this.
Yeah, and just touching on this, and I know this obviously it's a space that but clearly rentals, like pretty much anything else, housing during the pandemic were selling at a premium. Are you starting to see in different areas in Canada where there can be some really attractive um, opportunities for investors in terms of even like triplex and stuff like that kind of rental income? Because I'm just thinking, look, you're we're seeing in the headlines that overall rents are declining for most big
Yeah.
locales in Canada. I have to assume that that's dragging the prices down for rental units, so or buildings that that you could own as a landlord.
Yeah, so there's a couple of converging forces here that I'll talk a little bit about. So rents are falling, okay? And I think I've mentioned this a little bit when we talk about like CMHC, MLI Select, and just like
Mhm.
the market and how it behaves around rental product. But rents are falling in most places in Canada, and vacancies are rising, okay? But when you look at the type of product that the majority of investors are using to do these types of deals, and again, like if we're talking triplex, fourplex, that's below the minimum cutoff
Yeah.
currently for
Mhm.
CMHC, MLI Select. But anything 5+ units, people are buying with a product called CMHC MLI Select, which basically makes it possible for you to yield or like cash flow a property at a much lower income. And you do that by having a 50-year amortization. And this is where it gets interesting. On a 50-year amortization, So you're buying down your monthly payment, but you're also paying like 80% of your mortgage payment in the first 5 years of your term is interest. And so you don't like you care a little bit about your income inputs, so vacancy and rent, but you care a lot more about what the bond yield is doing, because that's what is going to impact your cash flow and pro forma more than anything. And so I think it matters a little bit. The part that I
Are
find
you seeing a
interesting,
discrepancy between that threshold of being eligible for MLI Select and not? Like, I would assume logically that anything below 5 units is probably trading at a discount because you can't cash flow it as well. So
exactly,
therefore, they
yeah.
have to compromise on the price. Am I wrong
Yeah.
there? Or?
No, you're right. So, where I mean, it's kind of just, show me the incentive, I'll show you the outcome,
Yeah.
right? So,
Mhm.
where historically, and like if you go to the US market or on any other normal real estate market, you would have the smaller you get, the higher the cap rate, because the more likely you are to, sorry, the lower the cap rate, because the more likely you are to um, be competing with an end user, right? So like the marginal buyer who has a
Yeah.
qualitative incentive to pay more than you as a landlord. But in Canada, your yields at like 5+ units are pretty much the same across the country, which is the craziest part. I mean, there's like Toronto and Vancouver are pretty standout, and then when you get into larger, more commercial products, you start to get a little bit more range in yields at a geographical basis. But your investors are basically making, they're basically willing to pay whatever the highest number that they possibly can is, relative to what that CMHC. And so your market basically right now is a spread over the Canada 5-year bond yield, or CMB maybe might be a more appropriate benchmark. Um, Simply because that's the biggest model input for any of the deals that are happening. So yeah, like it is a big market distortion, this product, to tell you the truth, on the valuation side. But the spinoff is the market distortion is in favor of tenants, right? Like it makes rents cheaper relative to the value of the property because investors are willing to accept a lower yield. It's investors that are absorbing the risk, and it's getting a ton of housing created. So nobody really seems to care, right? Investors are
Yeah.
like, great, I can get government insured, insane leverage. Renters are like, great, I can rent for cheaper, and there's a huge supply flood. And the government's like, or CMHC, who's issuing these mortgages, is like, we're accomplishing our mandate of getting more housing created, which is their mandate. So everybody's sort of feels like a win-win position, but there's the externalities do exist and are worth paying attention to.
Yeah, no, that's a good. I was just interested in picking your brain there. And in terms of the BOC, anything else that stands out for you? Obviously, they talked about headline inflation
Yeah,
reaching 3.2% in May. I believe they said it should get back to their 2% target in early 2027, with about
of course they
17
did. Yeah.
caveats and risk. And they even had an interesting question where there was a nervous reporter asking the question and was basically asking them, "Are you guys overly optimistic based on all the risks that you keep
Of
saying
course
with,
they are.
yeah, trade
They can't
risk?"
say, I mean, they can't come out and say it's all gonna burn down, man. Like, most of this whole thing, and, like, it's the policymakers as well, is, like, tempering expectations, like, trying not to look like an idiot by saying something that's so wrong that people can come back and burn you, which I think Tiff really learned his lesson with the rates will be low for a long time thing, and you can tell he's a lot more careful about the things that he says. But yeah, of course they are. Of course they're like way too optimistic. They
Mhm.
can't not be. They can't say that things are going to be horrible. And not that they are, but they can't say that that risk really exists, because then you get idiots like me who make YouTube videos about it and for the clickbait and scare people. So the one thing I did want to add, actually, on the outside of the BOC, but what we were talking about on the triplexes, fourplexes, etc., is the Canadian Spring Economic Update in 2026 announces the government's intention to increase flexibilities for mortgage insurers to offer products to borrowers building 3 and 4 unit housing. So you could see that unit number floor that I mentioned pushed down on the credit product that I mentioned before for all of the other things that I was describing. So that's an interesting piece of the puzzle. You're almost encroaching on your end owner occupied territory.
Yeah, that's pretty crazy. Like, it's
Mhm.
basically anything that's rental. That's more than a unit.
More
It's
than
not
two, yeah, because
more
like
than two. Yeah.
two you would still get. I think like one in five. I think it's 1 in 5 borrowers have a secondary suite in their house, which is crazy. That's a crazy number. So there's a lot of owner occupied that maybe have a mortgage helper or they're multi-generational households or whatever. And something like one in five who are purchasing want to buy a place with a secondary suite. So a lot of people are using this, and we see this a lot with our multiplex events. So we host these multiplex events across Canada. We put together a bunch of people who are experts in the space, and they present to a room full of people who are interested in learning as much about the space and investing in this type of product. And every year we have more people coming to these events who aren't investors, who are owner occupiers, who want to learn about how to do this stuff so that they can subsidize their mortgage or have their parents move in with them or move into their parents' place. And so that there's a line that I think they're trying to draw at 2 units, that where do we want to cut off investor capital from being involved in residential real estate, and where's the line where it kind of blurs into your owner occupied space and they're competing with the marginal buyer. And I think the last piece that I'll add that I think this is interesting to follow their thought pattern on is when they ban foreign investors can still buy 5+ unit buildings. So you're seeing a lot of foreign capital flowing into deals like the ones that I'm describing and using the product like the ones that I'm describing, and it's getting housing created. They're not net competitors in the housing market. They're net creators in the housing market. Will that is that setting us up to say, okay, well, we have the credit product and now we need to add the capital, and are we going to allow, because right now it's 4+ units for foreign investors and for 5+ for CMHC MLI Select. Are we opening the door for the foreign buyer ban to expire next year?
Yeah, I would not be surprised. And
I wouldn't be surprised.
Doesn't all of this just create perverse incentive of just taking on more debt?
Yeah, isn't that what Canada is all about? Like, that's our national sport, man.
I mean, it just feels like we're kicking the can down the road or just creating some bigger problems down the road. But it's
well, like, I don't know. I mean, Canadians are not like at a certain point, like you kind of just just create a product for your market, man. Like, as much as I hate to say it, like we blame, like we as like a society or whoever blame policymakers or whoever it is for our problems, our debt problems, but they don't make Canadians go and borrow money. Like, yeah, it's expensive, and maybe you could argue that inflation has an impact because people are levering up to be able to afford basic life. But household indebtedness in Canada is now that climbed back to 180, and we saw a pretty significant.
We're number one.
Yeah, number one in the G7, but we're typically top 5 globally, depending on if you're using debt to income versus a couple of other metrics. But like household indebtedness at 180% of disposable income, we've climbed back to that number after what looked like to me a pretty optimistic period of deleveraging for Canadians, and I was hoping that we were finally done with this binge. Obviously not. So we as individuals probably also bear a little bit of responsibility on this. But the challenge in a debt-based economy is, you go and, if you go finance a couple of vehicles and whatever, and, lever up all your credit cards, and then you go try and buy a house, the government's going to say, no, we're not giving you, or sorry, the lender's going to say, no, I'm not giving you more money. And now we have the same issue with us in aggregate at our economy. Hey guys, we need you to go borrow money to spend money on stuff to stimulate the economy. And then you go to the lender to ask them to do that, and they say, well, no, like everybody's levered to the gills. So you can't, eventually you run out of future self that you can borrow from. And I think that's the point we're at. Like, you can't hit much higher than 180. We tried it and it didn't work.
Mm-hmm. No, exactly. So, anything else on the monetary report? I know GDP, they're kind of wishy-washy on the GDP predictions. They say it should look a bit better by the end of this year and keep improving for the next couple of years, with the caveats again about oil staying in the 75%. And I believe it's been flat essentially for the last year.
Yeah, I think the other piece is Canadian dollar that they mentioned. That they basically observe that there's a risk of oil pass through to inflation, but there's also the Canadian dollar that's been depreciated. Could that pass through to consumers as an imported inflation? Right. Right here it says inflation could be higher if global cost pressures or the depreciation of the Canadian dollar pass through more persistently to consumer prices, or if excess supply is less than estimated. So I think that there's, the fact that they're paying attention to the risk of imported inflation. They're tempering two very, very tough beasts right now, which is one, you get oil-driven cost push inflation, and two, and you have to. So I think that this is illustrating to me their potential reluctance to cut, which is, if we cut too aggressively ahead of the Fed and CAD gets smoked, then we observe that there's a risk of imported inflation if we don't position the Canadian dollar strong for trading purposes and import purposes.
Are you seeing my screen right now, or
I'm not?
No, trying to.
There we go. I think I just had to turn it on.
Okay, there you go. Yeah, still getting used to this new platform, but this one I thought was really interesting when I came across that. So essentially, for those not familiar, so SEER is just like an exchange rate weighted versus other exchange rates. So they have the SEER, which includes the US dollars, and the one excluding the US dollar. And that's the one I wanted to focus on a little bit, is just, it's not just the Canadian dollar being weak against the US dollar. It's a Canadian dollar being weak against a basket of other currencies, and, a lot of it being trading partners. So just reinforce that. And I think I read on the monetary report, unless it was somewhere else, but they're also finding that businesses will likely try and pass on the prices increase to consumer, but they may face really soft demand. So they have limited flexibility at being able to pass that on. So I thought that was interesting, because we did a couple of weeks ago, we talked about Walmart and those price decreases that they had done. And I think what you're starting to see is businesses, maybe a quarter ago, were saying that, if oil prices stay elevated, it's going to pass through to the consumer, because we just can't take on those price increases and eat them. We can't continue doing that forever. But I think now you're starting to see a reversal of businesses saying, like, look, okay, I guess we have to figure something out, because we are realizing that we cannot pass that on to the consumer. The consumer is too weak.
Yeah, no, 100%. Yeah, and so this tells me that I think everybody's fearful, and even the U.S. Fed, it seems like, it's kind of trending in a similar direction with their language, that everybody's fearful that the oil price issues and gasoline price issues. I mean, oil prices are one thing, but gas prices are still at super elevated levels. Everybody's fearful that this is going to lead to a demand destruction, not that it's going to trickle through to inflation. And the most recent U.S. CPI reading kind of alludes to that being the direction. I think the fact that it's already come down a little bit, that makes me more confident with my original call that I felt that demand destruction was the more likely outcome for the oil price shock that we're heading into.
Yeah, did you see? There was also, I'm trying to find here, I don't know if I have the tab, but the data came out in the US. I couldn't find similar data in Canada, but the basket item at grocers are actually down. So the number of items that people are actually buying at grocery stores is down after being slightly up. I think in May. June came down, I think, 1.8% year over year. So people are actually buying less items as a whole at a grocery store. Again, tying in with what we had talked about with Walmart. And I'll be on the lookout for earnings calls for especially the big grocers in Canada, see what they are saying, because we have just a handful of not even like 3 large grocers in Canada. So they'll probably start seeing, that would be my guess, is that the next quarter they'll probably start talking about that.
Yeah, I would anticipate. Like, I think your read on that's pretty bang on. I think it's just a matter, like, I've never really been through a major market cycle like this. So my thing is, like, I always read about them and study them in a historic context. And when you're reading history, even though you see sort of like how many years pass by and the data points that you're observing, there's still, you're just reading it all at one time. And so you don't really have a grasp for how long things take. And so whenever I make calls, I often like speak about them or think about them as if they're going to be like, have some degree of immediacy to them. But the truth is that everything takes a lot longer to break than we might anticipate, which is the part that I think has interested me the most about this, is watching it play out and thinking, it's going to break soon. And then it's like, it takes another year and another year, that's one of the pieces that is actually kind of blown my mind on the whole thing.
And then something I wanted to talk about here. I know we had been chatting about that. So I'm just sharing Polymarket here. It's very similar for Calsheet. So share this tab instead. So you see before the orange line is before 2027. So essentially, prediction markets are saying that the next next Fed rate hike, there's a 50-50 chance that it happens this year or not. And I thought that was really interesting because there's a bit of disconnect with the CME Fed Watch tool that still says that there's 100% chance for a rate hike by the end of this year. I tend to believe the prediction markets here just because the CME Fed Watch tool has been wrong quite a bit over the last 2, 3, 4 years, ever since the rate hiking cycle began
Well, I think
in
like
2022.
I'm gonna I got to bring the chart up again. The market is not good at pricing and what's going to happen with rates. You know, like I think we
Yeah,
can just call it what it is. Like
exactly.
Fed fund futures, literally not a valuable thing to use on what it's always, I think it's good to use on what the
Mhm.
market thinks is going to happen, because that weighs on sentiment and the way that people are allocating assets. But it doesn't, if you're actually using it to use it as your crystal ball to guide your decision making process, you're literally flipping a coin. It's wrong 50% of the time, right? So, or greater than 50% of the time, like, as it shows on this chart. So I would fade Fed fund futures pretty much. Like, I think that would be, I always like looking at it and figuring out, seeing what the market's thinking. Yeah, because there's always a trade to on the other side of it. If something happens where the market was sure that they were going to hike and then it comes off, and you can always catch the opposite side of that trade as sentiment adjusts. But otherwise, it's not a good guidance tool, right?
No, exactly. And so I was working on this morning because I just started digging, and then like sometimes you get in the rabbit hole and you just keep going and
Oh
going
yeah,
and going.
trust me,
When
I've been there.
you've been there, than that. So I did this chart just to an illustration. So it's based on U.S. Treasury data. So it just gives you an idea. It doesn't, like, the main thing to see is this is new issuance that is done every year, whether it's new debt being issued or debt that's maturing that's being issued. And the big blue line is U.S. Treasury bills. So anything under a year. And you can see the issuance as a percentage just keeps increasing over time. And the reason why I'm showing that is because the more you issue on the shorter end, the more you're dependent on the Fed's fund rates in
Yeah,
terms of the interest rate. Obviously, the longer you go on the duration curve, the more the bond markets will actually dictate what the rates are. Obviously, I know eventually they could start doing some yield curve control that does have some other consequences to it. But I just wanted to show this, that look, there's more and more being issued. And we saw the Genius Act in the U.S. that essentially said when it was approved last year for stable coin issuers, the essentially requirements that they have to use U.S. Treasuries, and most of them will likely just use Treasury bills. So you're creating this new demand, and a lot of people around the world, sure, they would not be getting any interest on those stable coins, but if you live in a country that has rampant inflation, you have an extra incentive to actually own US dollars almost as capital preservation. So the reason I wanted to say that is the Fed does not, I mean, these are smart people, Scott Bessent, Kevin Warsh, and let's be honest, in reality, yes, they're supposed to, the US Fed is not supposed to be concerned by the fiscal side, but let's be honest. I mean, they are. I'm sure they're working hand in hand with US Treasuries. They probably wouldn't say so, but at the end of the day, I think they realize that the interest cost is just so high and something has to give. And I do suspect that long term, what they are probably trying to brace the public for is that, get ready for inflation targets that'll be more around 3.5%. Not out of control in terms of inflation target, but even said in his initial press conference, he didn't alluded that that 2% target is kind of just arbitrary. So
yeah,
I think, yeah, go ahead. You can,
yeah.
I'll chime in after.
I was just gonna say, I mean, the Bank of Canada has dropped studies on this too. Like
Mhm.
so we know that they're at least, like, at a minimum, they're paying some attention to it, right? They did a staff working paper in 2018 on, could a higher inflation target enhance macroeconomic stability. So this is, and you've heard the Fed mention it too. And I think myself and a lot of other people have talked at length about how, you know, it would be worth bracing for the Fed and or all central banks becoming a little bit more comfortable with a higher inflation.
Mhm. Yeah, because if you just start looking at the numbers, just 100 basis point increase in interest rate probably results in 50, just you looking at treasury bills, 50 billion, 60 billion or so in higher interest costs. And obviously that'll increase as the debt increases year after year. But it just goes to show that they don't have a whole lot of flexibility. And one thing that they have more control on is that shorter end of the curve. And at the end of the day, we all know the US has a massive debt. I think what, 39 trillion, 39.5 now it's at. Um, the only way that they can really go forward medium to long term is they have to do either a hard default or a soft default. And we all know that they won't do a hard default. So the soft default is you devalue your currency, you repay the debt with money that's worth less over time. So bondholders will take the hit, but what we'll probably see is longer term bonds will probably rise in yield as the market demands that, unless they start doing some yield curve control or they just start issuing almost everything on the shorter end of the curve. All that to say that I don't see it that they would rate raise rates. The
Mhm.
more you think about it, the more I'm like, really, are they really going to like raise rates? I just don't see it. Yeah.
No, yeah, I'm the same, man. I've never felt that that was going to be the case. Like there are the I think like people have a hard time deciding which doomer case they want to lean on. And, there's the stagflation people that are like, "Oh, stagflation's the worst thing that we could ever see," and they just pick the meanest doomer case that they possibly can, and so they lean to stagflation. But I just don't see stagflation or the hiking to try and temper inflation being a realistic outcome. I completely agree with you, and I didn't. I'm like, you can tell, you can feel it on the ground that recession is a far more likely outcome than a ripping economy. And actually, I might use that to segue, unless you had something else that
No,
you wanted
no.
to
I
add
just
there.
wanted to because I just wanted to mention it because it does have impact on what Canada does. Obviously, what the Fed
Yeah.
does will have an impact in Canada. So I just wanted to say that because I think a lot of people say, well, what if they raise and then Canada might be forced to raise because the gap
Mhm.
will be too big between the two countries. The Canadian dollar will weaken further. Don't be so sure that they'll be raising rates. Is just
Mhm.
what I'm saying. Yeah.
Yeah. Yeah, so my thought, the one thing that is kind of an X factor that's outside of both monetary and fiscal side is CapEx, right? Like, you have the 5 of the biggest companies in the world spending, more money than they've ever spent, and being comfortable with negative free cash flow to do so. And so the AI, the AI CapEx boom and the trillions of dollars that are being spent there. Also, I think, if I'm an investor, I'm saying, well, clearly this country needs major capital for infrastructure purposes. So that could be creating a little bit of, the ability for them to charge higher rates on a yield basis for bonds. And I'll use that to segue a little bit, because you mentioned about Kimmy and like just what's happening. I mean,
Mhm.
I think
Yeah.
last week was one of the most insane weeks for progress in AI since like GPT-3. So you had like Fable 5 like a couple of weeks ago, and they kept resetting their limits. And then you had ChatGPT come out with 5.6. You had Grok 4.5, which, to me shows that the SpaceX AI acquisition of Cursor is paying off almost immediately, because they're fine. Like I've never taken a Grok model seriously, to be honest with you, and I do now. Um, you had Meta randomly come out with Muse Spark 1.1,
Mhm.
and interestingly, that's what got Zuckerberg back on Twitter to announce it, because that's like, where all the developers are. Um, and then this week you got uh,
Kimmy. Yeah.
Moonshot, yeah. Oh, and,
Yeah.
and two
Moonshot.
weeks
Yeah.
ago you had GLM 5.2, which was the first Chinese open weight model
Mm.
to get to Opus level, like Claude Opus levels of intelligence. That's an open weight model, so you can go and download the weights and run it on your own hardware. And this is when you think about the threat. And like, I don't think it's a threat to a place like Nvidia, who's going to be selling you the hardware to do that. If you want to run it at your own house, you want to go buy a Blackwell and use it to heat your Canadian house. Like, not a bad idea actually, but You know, and did you see they have that? You can buy
No,
like
I didn't see
oh,
that.
dude, I'll pull it up. It's
I think you
crazy.
showed me an image of like maybe a month or something ago. Yeah. You can have it like almost in your backyard, use it.
Yeah, dude, they'll literally install a
Yeah, I think you're
like
the one, I
a
think.
data
Yeah, that
center.
showed that to
I
me.
think we've
Yeah.
talked about it on this before,
Yeah.
but yeah, like they'll literally install a data center on your house. Um, so anyway, all of that to say, you know, when we, I don't worry so much about the Nvidias of the world. I think their big headwind is if developers of AI product get off of CUDA, which is the type of development that
Mhm.
you develop
Sure.
these models on, and China is actively trying to do that with the Huawei chip layouts or configurations, or I don't know what the technical term is for it. So that, you know, that's the headwind for an Nvidia, but the headwind is for more for your upcoming IPOs with Anthropic and OpenAI, who now all of a sudden have competition that can sell the same thing, at least on an API basis. Like, why, you know, the question is like, why would you still use a US model if you can go get a Chinese one for cheap? I can think of a couple of reasons and we can discuss them, but the big reason right now is because as it stands, Anthropic and ChatGPT will subsidize your consumption on a pro plan to the tune of 10x. So um, you know, until that goes away, until everything's on API, which we probably get to, you know, they're more compelling. But it is, you know, this is a real risk for these labs in Canada that or in the US that are at risk of being replaced by Chinese open weight models.
Mhm. Well, a word of caution for the IPO too. SpaceX is well below the IPO price now. So I think that would, if that then doesn't give them pause at a potential IPO, I'm sure how SpaceX is doing, and that's only with a 5% float currently trading. So I don't know what it's going to do when shares start unlocking. I think it's going to be towards the middle or end of August. There's going to be starting to be some unlocks, but that would be the other reason there that yeah, SpaceX IPO did well at the beginning with all the hype, but some issues there. But the other thing I can think about for AI that could become a bit of an issue is, so we're starting to see a lot of in the US. There's a lot more and more temporary bans that are happening on data centers in cities. New York, I think 2 days ago, just passed the first statewide ban on new data centers being built. Apparently, there's more states considering that. I know there's cities as large as Seattle, Reno also put some temporary bans on. If you're seeing more and more these bans going on, isn't it a risk for the hyperscalers with the build out? I mean, they're obviously making plans. They're obviously making plans to buy those chips, those GPUs, the memory. We even saw Micron having a certain volume take or pay assigned with some of uh, the hyperscalers. I mean, isn't that a risk if you start like making sure you can get your hands on that equipment and then it just starts sitting on a shelf, devaluing while you're not even using it? To me, that's another risk that we're not really talking about all that much.
Yeah, no, excellent point. I think the land is a very small component of the total cost of these.
Mhm.
So, yeah, if you bought land in New York, you know, it's not like they're paying the trillion, like, you know, $1 billion for a piece of land, and now they have to sell it into an illiquid market. Like, they're buying in most cases raw land, which is why the governments have the ability to even exercise jurisdiction or prevent these projects. And so it's not worth like an insane amount of money. The loss would be absorbable. Like, if
Mhm.
even, you know, most developments of this scale, like your land cost is like less than 10% of the total piece of the cost structure. It's even less when you think about them building a massive building and filling it with incredibly expensive GPUs.
Mhm.
Like, the who cares, you know? I think, you know, to me, I think that you're
So you
gonna,
think they'll just turn around and go somewhere else that will allow them to build
yeah,
it?
and pay a
Yeah.
little bit more
Mm.
on cost to get the power run there. Or I mean, they're limited in such that they have to go near um power plants. You know, like they have to
Yeah.
be close to big power sources. The compute of the internet go like the you know, your Ethernet cables or whatever getting there is a little bit of a consideration, but not a huge one. I know the space pretty well because I
Mm.
used to help people buy Bitcoin mining facilities in in like 2016,
Yeah, I
2017.
remember. Yeah.
And yeah, we flew all over the country doing a lot of that stuff. And so um, your compute matters a little bit more than your internet connection matters a little bit more than Bitcoin mining, but not a ton. The big piece is power, and so they're limited to, okay, yeah, there's maybe 1,000 areas where I'm close to a sufficient amount of power. Um, Alberta, which you have on screen here, being one of them,
Mhm.
where they're just flaring natural gas, and we could easily get power for basically free. Um, I think this is an opportunity for um, municipalities or state governments to start doing their actual job. They're all corporations, by the way. They should be
Yeah, they are.
competing with one another to create good policy environments to if they want economic growth. And you're gonna and there's such an easy winners and losers case, and we think about this constantly when we think about real estate investment, which is which jurisdiction do I think is actually going to make good economic decisions and boost the value of my real estate asset through the infrastructure that they create? That's going to create jobs, it's going to create economic growth, etc. And you can easily outperform the market by picking the right place with the right policy. So you can see it in Alberta, you can see it in other places in the US where they're like, you know what, we don't negotiate with terrorists, right? We don't pander to NIMBYs.
Mhm.
So we're just going to do what we want, and if you don't like it, then there's 10 other provinces in Canada that you can go to, or similar thing with certain states in the US. So you now have the ability for the public sector to start competing with one another in the product that they deliver to their consumers, who are taxpayers, and benefit from infrastructure and economic growth. That's my 2 cents on this, which is nice to see. And you can see it
Mm.
happening in Canada with development charges city by city, so many different policy layers where municipalities are starting to finally compete with one another because they realize that the taxpayer is their customer and they actually want to earn their business.
Yeah, and this for those that are just listening to the podcast. So essentially, Tourmaline Oil announced that it would be building, or I guess they're looking for a tenant or a partner to build a data center, and they would
Yeah, it's
have
almost like an RFP, I guess, eh?
yeah, yeah. Essentially, it was kind of weird when I read it. It's like they don't have a partner just yet, but I guess it would be one of the hyperscalers most likely, and they would build a essentially a power generation facility on natural gas. So it's something I had talked about on the podcast probably 6-7 months ago. Is that you might start seeing this where you have natural gas that is trapped. Because we just don't have the infrastructure to send it elsewhere. And you have these natural gas producer like a Tourmaline that decide, you know what, we're going to partner and we're going to make sure that we find other uses for natural gas that we have that we can't send to the US or the West Coast or anywhere else in the world. And that's what they're doing right now. So I thought it was interesting. It came out just this morning. It was a CBC News article for Edmonton for those interested.
Yeah, I mean, there's a lot of I posted about this stuff on my Instagram, and like people get really, really serious about data centers.
They're not
Um,
they're not thrilled, happy, mixed, or
no, I mean, it's.
a lot of NIMBYs
I
or
think most
yeah.
people just really don't care, like,
Mhm.
but like the people who do care a lot. I don't, did you see my ex post on this about like it was inspired by my rant last week on this show about how, people they want to be able to scroll, want to be able to have an infinite scroll and use ChatGPT for free, but they don't want to have a data center near them. It's like, you know, you, you have to think about the consequences of the things that you need in your life. And so I gotta find the
There's a
actual
very small
post.
proportion of people who actually pay for an AI subscription, and that I think it's
5%.
like
Yeah.
5%. Yeah, I think it's a really low number of the amount of people that actually pay for it.
Here's my tweet. It says, "We don't want data centers. We hate them. They're bad and evil and serve no good purpose." And then it says also people, and it's just like a picture of a guy on his phone all night under the blanket, and then like a screen time like 18 hours on ChatGPT. So anyway, it's always amused me, the cognitive dissonance that people have, and they don't know what, it's like, I hate cops, but I also hate crime. It's like, well, what? Anyway.
Yeah, and I mean, for me, it'll be interesting how this develops because I still think it is a risk. I understand what you're saying that these hyperscalers can just choose another piece of land. It's not like land is the largest capex expense in the build out. but you also have to factor in qualified labor. You also have to factor in enough power nearby to be able to get to the data center, but also changing those plans. I mean, at the end of the day, that takes time too. Like, I'm not saying when you have something planned and then you're like, okay, well,
Yeah,
there's a
engineers,
temporary.
studies, approvals. There's
Exactly. So
lots.
there's
Yeah,
a temporary ban. Will it be renewed? Like, should we just wait until the temporary ban stops, or will the city council or the state start extending it indefinitely? Now we'll make new plans. So I think that is one part of the risk that I do think is there.
yeah,
Um, you might not agree with it, but I feel like there
yeah. I
is
agree.
just
I mean,
enough.
these are the risks that we study constantly on our show, right? Like,
Mhm.
it's funny to me that all of a sudden people are observing that real estate development is hard. Like, because you now have all of these
Yeah.
massive, everybody was like, oh, greedy developers, blah blah blah. It's like, well, now you have all the biggest companies in the world all of a sudden need to become real estate developers overnight, and they're realizing that there's a lot of headwinds. There's market risk, there's geopolitical risk, there's legislative risk, there's NIMBYism, right? There, community risk, environmental risk. Like, it is so cool to watch real estate development get pulled into the limelight in such a big way with these data centers, and anybody who's been in the industry for a long time just laughing and being like, oh, they finally figured out what this is all about, right?
No,
Yeah.
absolutely. And I guess maybe the last topic I wanted to touch, unless there's something else you wanted to talk about in terms of AI.
No, all good on my end.
Okay, so I want to pull here. So I don't know if you like. I know you pay attention to the stock market a little bit, not as much as I do, and we do on our show. But this is the SMH, really good proxy to see what's going on in the semiconductor space. You can see some of the largest holding here. Is my screen sharing? Or you blocked me again, Dad?
Yeah, I have to click a button to add it to the scene for some reason each time.
Okay.
So it should be good
There you
now.
go.
I think
So SMH, so the VanEck semiconductor ETF, really good proxy if you're looking to see how semiconductors are doing. Obviously, the names that people are very familiar with: NVIDIA, 20% weighting. You have TSMC, Broadcom, AMD, Micron, and so on. But what you can see, this is a chart for actual drawdown. So I'll make it a bit larger so it's easier. So it just looks at recent peaks and then where we're at right now. And essentially, we're in a 15% drawdown. And the issue we're getting is that semiconductors are becoming a larger and larger portion of major indices because they're all market cap weighted. So if you start looking at the S&P 500, it's almost a tech index at this point, or the QQQ. They are feeling that impact quite a bit, and it just goes to show that the markets right now, as soon as this sector sneezes, the whole market catches a cold. So
yeah,
that's what you're seeing. And I thought it was interesting because you're starting to see investors questioning whether, like, it's easy to see the profits. I mean, you don't need to be a mathematician and looking at the earnings of an NVIDIA, Micron, AMD, you name your semiconductor, that they're just crushing it. ASML, who produces the EUV machines, so extreme ultraviolet, essentially the machines that produce the most advanced chips, they're saying that they're getting orders left, right, and center. They actually want to increase capacity, and you're talking about machines that cost 250 million plus. So these are massive machines. So increasing the capacity for that, they definitely have to see that there is demand there. And you're starting to see memory makers that are traditionally been in a very cyclical industry, which chips are. So chips are very cyclical, and they've always been a bit reluctant to add in more capacity because of that being a cyclical industry. You don't want to add too much capacity, and then you go into the downturn, and you get the double whammy. They're saying that demand is through the roof, but what's really interesting is now you start combining that with what we just talked about, some of the potential issues in the build out of data centers. You also start thinking about some of the cheaper models. Are businesses starting to shift to, okay, AI, yes, we can tell it can really help our businesses, but we also have to rein in cost. And I know this is something we've talked about in the past, is at which point do you feel like you start, spending based on the task? So if you're just looking to summarize A paper that's 50 pages, maybe you can do that with a less advanced model versus if you have a really advanced agentic task, then you use Fable, the most recent model for Claude. So do you think like businesses will start doing that? Do you think it'll have an impact potentially on the earnings of these or the profitability or lack thereof
So
of these companies?
this is such a good question, and it's funny because like we've done a whole research thing on this for my industry, which is the real estate space, and we analyze every time a new model comes out. So we've already started analyzing Kimi on, this is realtor work, but from the start, and the industry is just getting to this, and I think it's interesting to see the model developers stop trying to push for the most intelligent model and start trying to push for the most reliable and cost-effective model. And they're acknowledging that there's an upper bound to that willingness to pay curve that you're describing.
Mhm.
But we went all the way down. We analyzed like everything that a AI can do that a realtor can also do. So like your showing, booking, and coordination. I'm just using this as a real world example because we've done
Yeah, no,
analysis
it's
on it,
it's
and it's
great.
what
Yeah. Mhm.
regular knowledge work, right? CRM management, MLS property and document work, offer writing and assembly, and we rank all the models, which Kimi, by the way, beats Fable 5, which is the crazy part.
That's
Beats Fable
amazing. Yeah.
5, not just Opus. It's crazy.
Yeah.
And then we have like full ranking breakdown. But the thing that I think that we did that I haven't seen anybody else really do on
Oh, the cost.
analyzing AI
Yeah.
is, so we do the unit economics of this, which is cost per CRM follow up, right? Like, so 4 cents per CRM follow up on Kimi K3 on API. GPT-6 Soul is 7 cents, right? Cost per home evaluation completed. And I think that this is where the market is going to have to start being more intelligent about the way that we think about these API input costs, because there are a lot of tasks that actually you cannot get an AI to do them for less money than a human, and there are a lot of tasks that you can. And the unit economics, and I think the more that labs start to cater to that being a thought process, this is we've discussed this. This is going to be the biggest catalyst. And I think the catalyst is whenever Anthropic and OpenAI flip into IPO mode and having to start being accountable to shareholders. Nobody,
Yeah.
I'm not buying either of those companies if they're subsidizing people's AI consumption to 10x what they're paying them a month, right? Like that was just a stupid thing to invest in.
Mm. Yeah, there's only been kind of rumors of how much money they're losing because they're all
Oh, dude,
losing
there's a
money.
table. There's a
Yeah.
table. Hold
Have
on,
you
I'll show
seen
you.
it?
It's
Yeah, I haven't seen
crazy,
reliable
dude.
data on it. It's more,
Let me see
it's
if I can
still,
find it, and we'll wrap
yeah,
up with that. It's crazy.
because they are losing money. That is the, yeah.
I think with the ChatGPT, is this it here? So with a ChatGPT Pro, you can get that's $200 a month in compute. You can get up to $14,000 in compute. I think here I have the table here. 1 second. This is crazy, dude. Like, so this is whenever this. I get the vibe that they're all behaving as though they believe that the unit economics will improve.
Where do they get that data? Or it's like okay, it is approximate. Okay.
Yeah. So so $200 a month Claude Max, $8,000 a month you can spend. $200 a month ChatGPT Pro 20X, you can spend $14,000. It's not hard to calculate, right? Like the data,
No.
because you know how many tokens you consume, and you know what a token costs on an API basis.
Yeah.
But if you were to use max out every single time, which not a lot of consumers are doing, so they're not every single person that's using it is consuming that we're describing. But it still illustrates how bad the business model is. If to make the product compelling, they priced it so low that they cannot make money based on their input costs.
Yeah, now there's so many models too that it just, the risk of this becoming a bit of a commodity is real too. So
I know,
you
man.
just, yeah, it's
And they keep self-improving. So like the rate at which you're getting the Chinese models who have way more users and user data, right? Like anybody in China, they have what, 3x the number of people using AI compared to the US. They're going to develop faster because the way that these models develop the best is through the user data.
yeah.
The one thing that originally you were seeing Chinese models losing at was US companies were afraid to use them because of data concerns.
Yeah.
But because they're open weight, and if you put them onto the right hardware in the US environment, you actually don't really run the risk of that because you're in control of the hardware where the data is being processed. And so you're actually seeing a lot of US companies switching over to open weight local production. And so that, where Anthropic and OpenAI did have a little bit of a wedge, where they were, they were getting into the sales funnels and saying, hey guys, you don't want to trust these Chinese open weight models with your, legal AI company data or whatever it is. They're starting to lose there in a big way.
Yeah.
And that's even more fascinating. So
Well,
man, this is like just so cool to watch, to be honest.
Yeah, I mean, you can just Google, anyone who wants to do it. You'll find examples of large companies essentially capping the AI usage for its employees because they would get like massive bills, and now they're capping the AI usage or purposely throttling it or encouraging to use cheaper models. So that's what you're seeing. But it's just very fascinating, I find, for unit economics, and I'm looking forward if they ever IPO. I guess we'll see. Maybe they need to IPO because private markets at some point will just not want to give them any more money, and then they'll have to tap the public markets.
Yeah. Oh, I think that they're probably running into that point
Right now.
especially if
Yeah.
well, yeah, and especially if the viability of a really, really juicy IPO starts to disappear as the market comes to the terms of the fact that, I mean, there is definitely a point where this gets scary for them, I think. And you still want to be able to capitalize on, no offense to the market, but the stupidity of the market right now. Like, people are willing to buy stuff at insane and stupid valuations. Like, you might as well use that to raise money and then, let the valuation blow off. Like, look at SpaceX and like that they wanted to be the first one to do this. Really,
it was probably smart for them to do it
because
now
in trouble.
Yeah, because now, I mean, especially with how the stock is done, clearly SpaceX, they're fine right now because they raised the money they needed to raise.
Yeah.
But it's not even. It's been what, like a month and change, and the stock is it's already below the IPO price. So it is a cautionary tale, and potentially some investors will see that and say, okay, maybe we'll just wait and see what happens with these. With OpenAI and Anthropic. But I think this is probably a good point to end it. Anything else, Dan?
No, I think we're good.
Yeah, it was a fun one. Yeah, different topics. Let us know too if there's different things you see, especially on the macro front, that you'd like us to talk about. Happy to dive into those. We do it a bit differently here than our respective shows. It's always a fun discussion. We do some preparation, but there's also stuff that we kind of do off the cuff, and I feel like we have ideas that kind of come in as we talk. So it's always fun to do.
Yeah, 100%. Cool. Yeah, thanks, man. Have a good weekend, and I'll see you again next Friday.
Okay, sounds good.